Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy with all your monthly ETFs. So today, which Nasdaq targeted 20 fund is better for retirement? The QQQT from Defiance or the XQQI from Neos? Well, on the top, Neos, always a stronger program, always another strong company, but that X giving you that targeted and how are they doing the targeting with, I hate to use the word, leverage. We're going to talk about it. Find out, can Neos handle leverage or is it off to someone else? So grab your mug, fill it with your favorite beverage, sit back and let's relax for the next few minutes and let's see which fund actually works and will this fit into your strategy. Hey, before we go any farther, we got to do our disclaimer. This content is for educational and entertainment purposes only. This is not financial advice. This is only entertainment. Past performance do not guarantee future results. So the 20% target, now really want everyone to understand, when you see any fund that says target, it doesn't matter if it's 12%, 15%, 20%, 50%. What it means is target means they're trying to hit the bullseye. They're trying to hit that magic number. So in this case, they're trying to hit 20%. Their whole goal with the fund is to achieve a 20%. So they're going to do everything they can to try to hit that number, do what they can. If they give up some growth, they give up some, they got to use different things to get to the number, they will. So is it possible to get a 20% with a Nasdaq 100? It's awfully high, and we're going to see if they can do it. So let's do a quick comparison of the two. QQQI from Defiance and XQQI from Neos. Well, they're both shooting for that distribution rate of approximately 20%. The SEC yields that we're seeing from it are in negative numbers, which means they're not getting much in their interest. They're not getting much of anything from dividends. It's all got to be coming from their structure, their strategy, how they generate income. Now, expense ratios on both of these are outrageously high, in my opinion, especially for retirees. When you take a look at 1.2% or 0.98% from Neos, both of those numbers are extremely high. Why do I say that? These numbers tell you the carrying cost for long-term portfolios. So if you had $10,000, it's costing you $120 to carry the Defiance, $98 to cost Neos. When you look at other funds in the Nasdaq 100 built for income, they're talking more of 0.5%, maybe 0.65%. So that means $65 to carry for a whole year, while these guys are almost double that. Now, this fund, Defiance, came out in June of 2024, so it's got a little bit of track history underneath it. But February 2026 is when Neos introduced their leveraged XQQI. Now, a lot of people were excited about it. They were like, whoa, this is going to be the next greatest thing because QQQI did a very, very good job. But now this is a boosting of it. And is it good for it? So the core strategy is the daily Nasdaq 100 credit call spread for income, direct QQQ exposure from Defiance, and boosted option-based exposure up to 150%. And they're also going to use that selection of 1256 tax contracts, which means they're going to be investing in the index as well. It's that 150% leverage, and if you don't understand leverage, that can be dangerous. It can be a good thing going up. It can be a good thing going down. Now, when we take a look at the fund assets, we're talking $46 million in QQQT from Defiance and over $260 million from Neos. I truthfully am going to tell you guys, I think the Neos thing is building off of its nameplate and the past history of QQQI and people wanting more growth. So I get 20% now using a similar strategy and they're jumping into it. But I think we're going to learn something. So the strategies, that daily call spread income, they take the core investment, which is almost entirely into the Invesco QQQ, for the premier and primary part of the Nasdaq 100 exposure. It does daily spreads. It uses daily Nasdaq 100 credit call spreads to capture regular option premiums. The income output is the option premiums fund high monthly cash distributions to the shareholders. So they're targeting 1.7% of their NAV price out as a distribution. That gives you a 20% targeted with that 1.20% expense cost. Very, very aggressive. I always want to be up front with you. QQQT is a very aggressive income strategy, but unlike XQQI, it doesn't utilize international boosted or leverage exposure. They're doing it all through the daily spreads. So I'm not going to even put safety into any of this. I'm not going to say, oh, safety here or that. No, these are very, very high risk plays. Now, XQQI, the NEOS program, uses boosted option exposure. Okay, this is leverage. It's a magic word. Boosted is leverage. It's giving you the leverage across the board. So the core strategy is the Nasdaq 100 exposure to the NDX call options, which is NDX is the Nasdaq 100, the systematic or synthetic options, strategic use of synthetic positioning to generate that income and leverage. So they're stating their annualized distribution is going to be between 19 and 23%, which gets a lot of attention out there. But remember, they're targeting a 20% final answer. Leverage, while it's 150%, that exposure can accelerate the upside but it also magnifies the losses and the volatility. This is why this is such a big, big play, and this is a very risky play. Because in downturn markets, this thing's going to go down that 150%. Okay? Versus on the up, it's going up to 150. So it's a double-edged sword across the bank. So distributions, I'm telling you right now, we're about equal with each other. As we said at the beginning of the show, 20% on Defiance, 20.72 on NEOS. Both SEC are a negative. That means all of those strategies have to generate that money. It's not getting it from any natural source of direct distributions or interest or anything of that. Let's take a look at the growth over the fund. Over the year to date so far, the growth of Defiance is up 1.02%. When we look at the holdings that they have, you can see they are heavily into the QQQ. They have the call options. They have the First American Fund that's a little bit helping them with the interest side, the SEC part of it. So you can just see they're really heavily into the call options and QQQ. When we look at the NEOS boosted side, though, this is another big factor. They are investing into these particular products. They have these holdings underneath their belt. They've lost 5.53% year to date. You can see they're heavily tech bound, which is what the Nasdaq really dives into. But the thing on the screen right now is that negative 5.53 part of growth. It does follow what the Nasdaq strategy is doing. But again, with leverage, when it drops harder. When it comes up, it's going to come up harder. So right now, it had a huge drop here in the month, late in July. It now has to have a big boost to get itself right back up. We see it, but we got to see more of it. Monitoring the total returns, though, year to date. I'm giving you year to date to show you because, again, XQQQ started earlier, or started, I'll call it later, is they started while QQT has more under its belt. But they follow each other fairly well, except when you see drop-offs. I see a drop-off like over here at the end of March. You see the big drop-off at the bottom where it was 10% off on XQQI. Then with the leverage coming back, it's regained itself. And we've been tracking all the way through. But now we can see in the last part of July, we've seen the downward trend of leverage hurting the fund. And QQQT wins the total return race of 11.65% versus 6.74%. Now you got to remember, these numbers are calculating in. If we're at 20% distributions and we're only at 11% now, it's going to be a gamble. Are we going to be basically no growth with just income coming in, which is what most of these funds are designed for? This is why we watch total returns so closely. The growth potential and the leverage aspect, 3-month NAV total return comparison. Nasdaq 100 over the past 3 months has gained 27.74%. XQQQI is showing a 26.57% over the NAV total return comparison versus QQQT. That is showing you the difference that you're running into using the leverage across the board. But it's not enough to say the risk factor is not there. So the total returns, as I show you again, 1-year total returns 18.52% for QQQT, since inception 14.35. The 6-month NAV was a 6.74. I should have put this on the screen as well because we just had that. The QQQT 6-month program is right around the 11 percentage points there. So there's a nice fight between the two. Is XQQI the emerging side? We have an established record on QQQT. I think QQQT wins this right now as NAV, as the total return goes through. Tax efficiencies. Starting to get more and more detailed on stuff for you guys, give you more information. QQQT using the ROC program, and they came out in August. They reported at 55.84%. Now remember, that number doesn't mean anything until you get your 1099 DIV report. So they're off a little bit using the 55% across the board. While XQQI uses the NEOS patented, I call it the Section 1256 contracts, the tax harvesting, ROC as well. So it's just more a tax efficiency way across the board. So NEOS will always win that side of it in my book because they have the system in place. The cost, we've talked about this enough already, of the cost structure of expense ratios, what's going to cost you down the road. Now I'm going to talk to you about risks. QQQT, the Defiance, really is going to tell you he's going to have the control and the risk control and the winner. That direct exposure to QQQI without intentional leverage or boosting is a little bit safer than the high volatility of XQQI. They can produce some decent numbers. They will continue to hold in that. Still categorized as an aggressive due to that daily call spread strategy and concentration. Longer operating history provides more data for us to work with, but I still have to tell you, this is still an aggressive one. XQQI from NEOS, that boosted exposure, 150%, is very, very dangerous. It's very powerful. In a retirement, I wouldn't suggest this one in any way, shape, or form, strictly because I don't like boosted and leverage in my retirement packages. So the strategic part of this, well, in a brokerage fund, I got to give the hands up to NEOS with the XQQI package. Traditional IRAs and Roth, if you have them in those packages, neither one of these two are going to give you any benefit, neither one of those two. But you got to understand what you're getting into when you're investing into these funds. So my final verdict, the biggest thing I can put out there when I started doing this was caution. It's cautious versus aggressive. I believe so heartedly that the Defiance QQQT, you have to be cautious when you invest in this no matter what you do. The more you understand the choice for income investors that seek that direct QQQ exposure, I think personally for retirement funds, there are better ones out there. And remember, this came from a YouTube subscriber that they were asking, which one do you think is better? I'm giving my personal opinion. And that is, QQQT does not interest me. It doesn't make me excited. I don't like targets. I like plans. I like wholehearted plans of where these things should be, how they should be, and where they should be. So longer operating history, definitely I like that side of it. But the aggressive income approach of trying to hit 20%, I just think is not there, doesn't need to be there, because there's other funds out there that can handle it. Now, for aggressive investors, you guys want to boost your stuff, you want to gamble, you want to play that big roulette wheel in the sky and do XQQI and boost your expenditure, more power to you. You do have some tax burdens behind you, but I just don't see the reasoning behind these in any way, shape, or form if you've had a plan from the start. So my final verdict to you guys is this. I personally don't like either or. I don't like I said, I don't like targeting. I don't like that in any way, shape, or form. And I don't like the leverage, especially when we're getting the retirement packages. And QQQT just has still a very aggressive package. So my answer to you is tell me what you think. Leave a comment down below if you think I'm too negative or I'm too conservative. But my answer to it, hopefully this is what you were looking for. Maybe you just want some encouragement because you bought the packages, you bought what you did. So I'll just tell you guys, that's my opinion. That's Doug's a retirement guy, sipping on my delicious iced tea in my cup today. So let me know your thoughts. And if you like what we're doing, hit that like button, and we'll see you at the next video.